Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. 22 weeks ago, and at every opportunity since, I said here, and I quote, "The only other thing to bear in mind is not here on this daily chart, but in Chicago soybean meal." And that is the well-highlighted annual key reversal down we saw there for 2023. Not directly related here, but not worth ignoring either. End of quote. I know I sound utterly boring, but this point is important, and I feel I must keep repeating it, such that in all things this year and going forward should be seen in the shadow of this pattern. Okay, so from the double top, we have seen prices head lower at the start of June and thereafter. 12 weeks ago, I added a small bright red highlighted bearish Andrews pitchfork for the action during May, and until mid-July, I had really nothing more to add to this pattern. It was not perfect, but it worked well, really well, until the changeover gap. And even then, I kept it on my daily chart to show the bearish angle of attack. We're right now between the broken and seemingly repaired bright red lower time below, currently at 965, and the middle time above, currently at 1003. Going back to the changeover break lower, the move down had been quite swift, notably 2 weeks ago, when prices reached down to the combination of the September 2020 low at 942 and the dark blue optimized extension to the February to October 2021 head and shoulders top, currently at 937. However, the market did not like it down there, especially testing those to the September 2020 low and the dark blue extension, and prices turned higher, only to meet the first of 4 bands of static supports that are now resistances. The first is at 990 and is being tested this week. Further up, we have another at the October 2020 low at 1017. Then congestion between 1031 to 1033, and finally the November 2020 low at 1045. The question now is whether what we have seen throughout August turns out to be a base building for a further move higher, or just a temporary halt on the road lower. Right now, it looks like it may be a temporary halt, though I would extend that into a possibly being the third way of just going sideways within a relatively wide range. Until the bright red bearish shift pitchfork is finally broken and not repaired, and broken properly, which is what it seems to have happened right now. We've had it broken and repaired, but only on the lower time. The upper time, when it's finally broken and not repaired, then this bearish pitchfork will be the dominant feature of this market and the one to watch. Chicago soybean meal. Back in late February this year, down at 326.90, the market consolidated after a significant fall that developed from the middle of November last year. This congestion was different compared to earlier ones, as it had backing it up the purple highlighted extension to the lower trend line, currently at 323.30, of the July to September 2021 descending triangle. I said 24 weeks ago, and I quote, "This may be nothing, but I'm minded after such a fall as we've seen since November last year, this just may see some hesitation around the 327 to 325 zone. I'm not certain on that, but it's worth considering." That's the end of the quote. Well, prices utilized this extension to the descending triangle as a base back then and rallied back up, eventually ending up being capped with a double top formed over the month of May, with additional help of the declining long moving average at the time. That's currently at 354.90. and also the 50% Fibonacci line of the August 2020 to March 22 move at 390 even. The construction of this double top eventually led to a move lower, down through the primary and secondary targets, but the key break lower happened at the third attempt, pushing down below the flatlining medium moving average, currently 342.30, in early to mid-July. 3 weeks ago, prices finally rose enough to fill in the significant changeover gap between 335.90 to 319.50. However, this pullback higher was not sustained, especially over the previously mentioned purple trendline extension. And 2 weeks ago, the market moved not only below this, but also down to levels not last seen in August and September 2020. 3 weeks ago, I also put forward a couple of features. The first was the bright red bearish Andrews pitchfork for the action between early July to early August. It has since developed, showing the very recent bearish angle of attack. Yet this week, the upper time, currently at 305.40, has been breached and is on the verge of being broken. If that becomes the case, and I ought to know by next week or at the week thereafter, then I will retire and instead use the less acute bearish shift pitchfork for the same move. Second thing is even more recent and even relates to this week's actions, is the weekly key reversal down made 3 weeks ago, which we have seen a limited but significant follow-on lower to even weaker prices late 2 weeks ago. Where it relates to this week's actions is that we're on the verge of making possibly a weekly key reversal this week. Thus, if tomorrow, Friday night, we close either over 302.30 or under 299 even, then we'd be on. Anything in between would have the lesser outside week pattern. Right now, we are very strongly looking at a weekly key reversal up and all the implications that provides. Last week, the moves lower left me wondering what next. The drop itself was halted and turned up, unsurprisingly, by the band of congestion detailed on my daily chart between 282 even to 300, dating from April to August 2020. However, does this mean the end of decline or just the end of a phase, if you like? I was also prompted 2 weeks ago to draw a mid-November 2023 to early May 2024 bearish shift pitchfork highlighted in dark blue on my daily chart. And we can see that the lows of the last 3 weeks were also testing the middle time of this, currently at 294.70, much as they did back in mid-July. It also pointed out how, and I quote, the market is likely to become squeezed between the sharply declining red upper time above and the dark blue middle time below. The situation will resolve itself with one or other giving way at the end of the first week of September, and in truth probably next week. And that's the end of the quote from last week. Right now we are looking at that resolution. Finally, 2 weeks ago I also took a look at the bigger picture here and put forward the possibility that the whole mid-November to date action could be seen as a possible large bearish halfway hesitation. This would give a potential down below in the 253 zone. In other words, down to levels last seen in 2016. I now only need to remind you of my words of 61 weeks ago and ever since, so well over a year ago, when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023. I've been living in the shadow of this pattern ever since. Chicago soybean oil. The market's drift of sideways to lower this year has been down through various congestion bands. These were, and are, 44.68 to 45.04, made up of the 2014 high at 45.04 and the May 23 low at 44.68. The nearby neckline extension of the October 2019 to February 2020 head and shoulder top, currently at 44.68. Then the tight 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line at 43.80 and the April 2014 high at 43.94. And with the green slowly declining short medium moving average below it, currently at 43.55, and the mauve slowly declining medium moving average, currently 44.15, above it. Next, we have the interesting congestion down at about 42.65, plus more recently congestion at 41.15, which today is support, and further support from the January 2021 low at 40.53. Now, prices 2 weeks ago even looked down at the November 2020 high at 39.04 before a fairly free zone all the way down to the December low, 2020 low, at 36.56. I mention all of these because some 59 weeks ago and numerous times since I've spoken about a big descending wedge pattern that was on my daily chart back then and is now high up off the top of my chart. To cut a long story short, I said back then, and I quote, I would consider this descending wedge pattern may have lately morphed into a possible scallop pattern, end of quote. Well, after some perambulations, this is what we got. A scallop pattern, descending scallop pattern. However, this was and is a big pattern idea with the expectations I voiced of eventually witnessing a fall down to the area of May and June lows between 48 even to 46 even zone, which is where we have been until recently. I've kept a very, very close eye on this idea, as any significant break below the 48 to 46 zone could signal the start of the rest of this move lower. Now, 5 weeks ago, prices finally punched down through the neckline extension, and at the same time started a definitive move lower, below the previously mentioned key 48 to 46 even zone. It seemed at the time that the market had come to a cusp and chosen a way lower, and as a consequence, I drew a new, early July to date purple highlighted bear channel, currently 33.48 to 39.04. All these actions seem to have secured some significant potentials on the downside. Thus, for the original much earlier mentioned 59-week-old big descending wedge pattern, we have the following opportunities on the downside. A primary target X would be in the 33.70 zone, with secondary much harder to reach target X1 down in the 16.25 zone. Even a cursory examination of these two targets, and one can deduce some notable points. The primary target down at 33.70 is just above the 50% absolute Fibonacci line at 33.45 and is, I suppose, doable, especially if you take into account the monthly key reversal down we saw in July. The secondary target at 16.45 is so far down that calling it harder is a massive understatement. We would have to be down to levels not seen since May 2002, and I would think achieving that is a monumental task, and one right now that in all truth I could not endorse. Late this last week and this week's actions, we have seen a strong move up over the purple upper bear channel line, as well as the January 2021 low, and the interesting congestion at about 42.65. However, to break higher from the bear channel, we have newer topside opportunities, more recent ones, of a primary target X2 in the 48.23s area and a secondary target X3 up in the 49.5 to 49.60 area. These two topside targets are not too far away from each other, and the move up would have to be quite dramatic to even have a look at them. So I am cautious about them right now. However, it would not be too much to ask for a move up in between the green short medium moving average and the mauve medium moving average, relieving some bullish pressures built up from the bear channel, yet still maintaining the longer term overall bearish incentive.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.